Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 650 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Today, we're diving into something that could be a game changer for your investment portfolio, healthcare REITs. You might be wondering, Iggy, why healthcare REITs now? Well, with all the market uncertainty and Trump possibly heading back to the White House, these REITs might be your portfolio's best friend. Let me break it down for you in a way that makes sense. Think of healthcare REITs as landlords for hospitals, nursing homes, and medical facilities. It's like owning a piece of Mount Elizabeth Hospital or Glen Eagles, but without the hassle of managing the property yourself. These REITs collect rent from healthcare operators, and that rent turns into dividends for investors like you and me. Why their special healthcare REITs are different from your typical property investments. Imagine running a bubble tea shop. During a recession, people might cut back on their daily bubble tea. But healthcare? People need medical services no matter what's happening in the economy. That's what makes healthcare REITs so resilient. Let's talk about why healthcare REITs make sense, especially in Singapore. Our population is aging faster than a durian ripens in the sun. By 2030, 1 in 4 Singaporeans will be over 65. More elderly citizens mean more demand for healthcare services, which translates to more stable income for healthcare REITs. Market dynamics. Interest rates play a big role in REIT performance. When rates go down, REITs usually benefit because their borrowing costs decrease. However, with Trump potentially returning to office, analysts expect a slower pace of rate cuts. But here's the good news. Healthcare REITs are better positioned to handle this uncertainty compared to other property sectors. Parkway Life REIT, the premium choice. Let me share why Parkway Life REIT stands out. Think of it as the premium condominium of healthcare REITs. They own high-quality hospitals in Singapore, including Mount Elizabeth and Glen Eagles. But they're not just staying local. They've expanded into Japan, Malaysia, and recently made their first move into France with 11 nursing homes. Here's something exciting about Parkway Life REIT. They're renovating Mount Elizabeth Hospital, and this investment is expected to boost their Singapore rental income by 24.4% in FY 2026. That's like getting a major salary increment. They've also maintained uninterrupted dividend growth since 2007. That's longer than most of us have been investing. Now, let's talk about First REIT. If Parkway Life REIT is like a premium condo, First REIT is like a well-located HDB flat, solid value with good potential. They're offering an attractive 9.4% dividend yield, which is like getting back $940 every year for every $10,000 invested. First REIT has properties across Singapore, Indonesia, and Japan. They're working on increasing their presence in developed markets, aiming to have more than half their assets in these stable economies by FY 2027. This strategy is like diversifying your CPF investments, spreading risk while maintaining good returns. The healthcare sector isn't just about treating patients, it's evolving with technology and changing demographics. Singapore is positioning itself as a medical hub in Asia, which could benefit these REITs in the long run. Think about how many foreign patients come to Singapore for treatment. That's additional revenue for these healthcare facilities. Let me share a practical example. If you had invested $10,000 in Parkway Life REIT 5 years ago, not only would you have received regular dividend payments, but you'd also have benefited from capital appreciation. The REIT has shown resilience even during challenging times like the COVID-19 pandemic. When considering healthcare REITs, think about your investment timeline. These aren't get-rich-quick investments. They're more like the CPF special account, steady, reliable, and focused on long-term growth. I recommend starting with a small position and gradually increasing it as you become more comfortable with how these REITs perform. Of course, no investment is without risks. Healthcare REITs can be affected by regulatory changes, healthcare policies, and interest rate movements. However, these risks are often lower compared to other property sectors because healthcare services are essential and heavily regulated. For those interested in getting started, here's my advice. First, understand the REIT's portfolio. What kind of healthcare facilities do they own? Are they in good locations? Second, look at their tenant mix and lease structures. Long-term leases with reputable healthcare operators are preferable. Finally, check their debt levels and refinancing schedule to ensure they're financially healthy. The healthcare sector is poised for long-term growth, driven by aging populations not just in Singapore, but across Asia. Healthcare REITs that can capitalize on this trend while maintaining strong financial positions will likely continue to provide stable returns for investors. Before I wrap up, here's a quick engagement question. Have you considered adding healthcare REITs to your portfolio? What concerns do you have about investing in this sector? Drop your thoughts in the comments below. That's all for today's analysis of OCBC's bullish stance on healthcare REITs. If you found this video helpful, don't forget to hit that like button and subscribe. Next week, I'll be doing a deep dive into why OCBC's bullish on Parkway Life REIT, where we'll examine their growth strategy and financial metrics in detail. You won't want to miss that comprehensive analysis. Until then, this is Iggy from the Investing Iguana, helping you make smarter investment decisions. Stay invested, stay informed.